Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, and I have Andrew Thrasher back with us this week. Of course, he's a chartered market technician and portfolio manager, so glad to have you back. Andrew, Joe filled in for you, as I'm sure you've seen by now. The two things Andrew and I will hit, or excuse me, three things we'll hit. We're going to take a look at the Federal Reserve and some current expectations. We're going to look at yields. They've really had a significant move, not just the last few weeks, but I'd say the last couple of months. And then Andrew will finish up talking about savings and where we stand with regards to the consumer. All right, so let's jump right into the Federal Reserve. And what we're going to see is a complicated chart, a lot of numbers, but I'm going to try to simplify this. And first, before drilling into the chart, the importance of the timing. This Friday will be the time that Chairman Jay Powell speaks at the Jackson Hole Summit. So a lot of the global central bankers, they meet every August. And oftentimes that's a time where they really clarify their expectations and what they're trying to do. If we go back a year ago, actually maybe remember June, July, markets had a pretty reasonable rebound until Chairman Powell really reinforced how vigorously they were going to be in terms of raising rates and holding them there. And that got the market's attention in both bonds and stocks. And we really had a rough few weeks from there. Not saying by any stretch that's what's going to happen, except that's the period of time where the Fed usually has an opportunity to speak and clarify their intentions. Not always. Sometimes it's nothing. We shall see. So now in terms of actually what the chart represents, the chart represents the percentage of each potential outcome for where rates will be in May of 2024 or the middle part of next year. The Federal Reserve, through their dot plot, which is what they give us 4 times a year, where they tell us where they expect the economy to be, where they expect rates to be, they believe they will be cutting rates. And this probability distribution is where the market believes they will be. And they also think that the Fed will be cutting rates, but not quite to the extent of where we thought they were a month ago. If actually you back up in time, what we would see is that the highest probability was that the rates would be around 4 3/4 and 5%. And now that is to the 5 and 5.25%, or just below where they are right now. And actually a much stronger possibility that they will be exactly where they are. So the market is catching on to this notion that the Federal Reserve is probably going to have their feet dug in longer than expected. So everything's on the table. Things can change. But as of right now, that has been the move. And what that has seen in terms of the market is driving up interest rates. So the driving force behind all of this, of course, is the stronger than expected economic data. Across the board, this is the period where a lot of experts, a lot of economists, forecasters believe the economy would be deep in the midst of a recession, if not already soon to begin. And in fact, the opposite has happened. In many cases, we see on the backs of what's been a strong consumer, the economy expanding. And so this is really what's causing the Fed to really dig in. And you can take a look at the next chart here. We're going to take a look at 10-year yields, and you can see the ascent here to 4.25, taking us back to levels we haven't seen since 2007. So what started off as a pretty decent bond year has given most of those gains up. Contrast to last year, one positive thing we can add in there is because rates were higher to start the year, there is some income that offsets some of those price losses. But the move up in rates has pushed bond prices back down as we see yields potentially breaking out and moving on into new territory as this stronger economy narrative is the one that is dominating for the time being. I want to pass the baton over here to pass to Andrew and really take a look at the health of that consumer, which has been driving things.
Yeah, thank you, Adam. So now we're going to shift gears. As Adam said, we're going to look at the consumer savings rate. So this is data that we get every month, looking at the average savings for each consumer. And this is important because we had kind of a big change in savings coming out of the COVID period, where the government had given all this stimulus, had given all these special checks. We got tax cuts, tax suspensions, student loan payments had been suspended. All these different things started to get changed within the balance sheet in the checkbook of the average consumer. And so the chart that we're showing today, if you look at kind of the lighter blue line, there's kind of several pieces going on here, but the lighter blue, and we see jumps really high after 2020. That's the accumulated excess savings. So we saw the consumer was flush with cash. That's what we saw. A lot of consumer type stocks do really well. The economy was doing well because everyone had all this extra money that had just kind of been given to them, or the tax rates, like I said, kind of everything had been suspended. And then we started to see the consumer start to deplete that. As you can see, the line started to go down in the late 2021 through 2022. And then we also see in the dark blue line is the personal savings rate. So that's the average amount um, consumers are saving, and you can see it in billions of dollars. So that's also started to decline. And all that's slowly depleted to the point where now we've kind of, the average consumer, the cumulative excess savings for the economy has actually gone negative. So we peaked over $2 trillion, if you can just wrap your mind around that. And now we're actually negative by $91 billion. So we've kind of had this period where the consumer had been really strong, flush with cash. And now we're kind of seeing how the consumer is going to be able to handle as that savings rate gets depleted, that excess savings gets depleted. The one positive here is we still have a fairly strong labor market. The unemployment rate is still near record lows. We still, as far as the labor market is concerned, there's still a lot of people still with jobs. It's what's going to be the issue is if that begins to change and the consumers don't have a lot of built-in savings and we start seeing unemployment go higher, then that could start putting some constraints, some strains on the consumer part of the economic growth. But right now, labor market's still, for the most part, looking pretty solid. So we're going to be able to kind of see how does consumer behavior change now that they've spent and depleted all that excess savings that had been built up over the last several years.
Excellent job, as always, Andrew. So thank you for that, and thank you to all of you for giving us your time. As always, we give you this reminder: if you think we can be of help, please by all means give us a call, 800-928-4001, or scan the QR code or visit us on the website. Hey, thank you again, and have a great weekend.